Hey everyone, welcome back to another session. We are a few minutes earlier, which is basically another way of saying we're on time, which is usually not the case with the events in general. But super excited to have all of you back. And my next guest here is Jake Alexander and from the company called um, Action Accounting. And the topic for the session is the top 5 strategies for coaches to save big bucks on taxes. Jake is a speaker, consultant, and a serial entrepreneur who has been in the financial industry for nearly a decade. He's worked with clients who have generated 7 to 8 figures in revenue, exactly our audience, by the way. And his greatest passion is empowering individuals to design their future on their own terms. Welcome, Jake.
Thanks, Natalie. Thank you so much for having me here.
All righty, let's kick it off.
All right, let's do it. So once again, thanks, Natalie, and the whole team for putting this together. Thank you so much for having me here. I'm humbled and honored to speak with you guys today. And I'm Jake Alexander with Action Accounting. Today, we're going to talk about the top 5 tax hacks for coaches. And I know what everyone's thinking. You guys are so excited to talk about taxes for the next few minutes. I promise to keep it somewhat upbeat and a pretty high level and not get too much into the weeds with this stuff because I know how that can get. So we're going to jump right into it. What I like to do anytime we're talking about taxes, I really like to just kind of set the stage and talk about takeaways in the beginning. A lot of times at a presentation, you'll talk about the takeaways at the end. But for me, there's really three main things that I like to focus on when talking about taxes. And that the first one is the tax code in general, right? The tax code is written for business owners. It's not written for employees. You guys are all business owners, so you know that already. And the reason is 2/3 of new jobs in the US are created by small business. Up to 40% of economic activity is attributed to small business. And so the tax code is specifically written to benefit business owners for pumping money back into the economy, for creating new jobs, for spending money on infrastructure and investing in their businesses. It's very, very important to understand. And when you utilize the tax code to its fullest potential, it's how you get the fullest benefit. And so, over the next few minutes here, we're going to talk about 5 just of the main deductions that I like to focus on, especially for folks like you in the coaching and consulting businesses. And it really just makes a lot of sense. And so, first takeaway is understanding the tax code itself. It's designed for people like you. It's designed to drive the economy. The IRS, they want you to spend money on your business and they want you to create jobs just like you guys are doing. The second one is, what is the IRS, right? In a nutshell, the IRS is a debt collection agency. Their job is to collect money, right? They're the largest, most powerful debt collection agency in the world. Their job is to collect money. Your job is to minimize the amount that you pay them. So, understanding the tax code is key. Understanding what the IRS is. At the end of the day, it's just their job to collect money for the US government. It's all about having the right approach. And what is that, right? We get the question a lot, what's the difference between tax preparation and tax planning? And the easiest way I can explain that to people is tax preparation is what we do for last year. Tax planning is what we do for this year and for moving forward. And so a great example of that is, we're right past the tax deadline here. If we were in a live room where I could have you all raise your hands and see it, I would ask how many people just filed an extension for their taxes. And usually in a room full of business owners, a lot of hands go up. There's nothing wrong with an extension. You can do that. But the reality is, when we go prepare those taxes at this time this year, we're just preparing them for last year. We're just getting you in compliance for stuff that's already happened. And as practitioners, there are things we can do to tweak some things and save you some money. We can look at the depreciation, we can look at a few different strategies, but what we're mainly doing is just getting you in compliance for stuff that's already happened in the past. Where we've got to get you to is tax planning, and that's planning for this year and moving forward. And that starts right now for 2023. And it's all about implementation too. We can tell you all the strategies that are out there over the next few minutes. Like I said, I'm going to dive in not too deep. We're going to cover them on somewhat of a surface level, but we're going to cover 5 of my favorite tax deductions for owners of coaching and consulting businesses. But it's all about implementation. If you hear the information, if you understand the information, it's great. But if we don't implement it, then you're not going to get that benefit from there. And so I really like to start with that. The 3 main takeaways: just understanding the tax code is written for people like you. The IRS wants you to spend money and invest back in your business. What is the IRS? Their job is to collect money. And what is the right approach? And for everyone, that approach can be a little different, right? That's why we're so big on tax planning. We like to make a specific and organized plan for you as a business owner on what is the best way for you to legally and morally pay the least amount of taxes as possible. And so, with that being said, we'll jump right into it. So, I want to go through 5 tax deductions for you guys real quick. And then we are going to have time for Q&A at the end. I know Natalie said maybe the chat was working or was not working. I'm not sure. If you do have questions, pop them in there. And if we can have time to get those to the end, we will make sure we answer all those questions. But I want to cover 5 tax deductions with you guys real quick. Some of the most popular ones that we like to explain here. The first one's home office. So, and when we talk about home office, this isn't one that, don't get me wrong. You're not going to save millions of dollars in taxes with the home office, but this is one that we routinely see add up to, six, 10, $12,000 in deductions per year. That when you look at the compounding effect over time, it's really going to have a positive effect on you paying less taxes over time. And so the rule for a home office is you got to have a separate area exclusively used for business. So when I say that, it has to be a separate room. It has to in your home or in your dwelling. Can't be, your dining room table where after you feed the kids dinner and get them to bed, you bust open the laptop and get some work done. Can't be like a mixed use room where, it's your office slash guest bedroom. Needs to be a separate area exclusively used for business. And if it is, then you could qualify for a home office. Once you qualify, we've got to come up with what we call a business use percentage. And the way we do that is we take the square footage of that separate area divided by the square footage of the entire home, and you come up with a percentage. And it's generally somewhere between 8 and 12% is the most common, sometimes a little more, sometimes a little less. But when you do qualify, we come up with that percentage. A lot of people don't realize you can take deductions on quite a few things here. So if you're renting the property, you can take that percentage of your rent as a deduction. If you own the property, you can take that percentage of mortgage interest and real estate taxes, the utilities, things like the electric bill, internet, phone, if you still have a home phone, anything like that, equipment and furniture, things that you might need to, stock the home office. So like this microphone here, for example, my nice paintings that I have on the wall, things that you're going to need to furnish and equip the home office, these can be deductible for you. Also improvements. This is one a lot of people don't realize. So if you're doing improvements to the overall structure, but you qualify for a home office, sometimes depending on what it is, depending on the situation, you may be able to deduct a cost of those improvements. So this is things like a new roof. You can't put a new roof on all of your property except for the home office portion. You have to put the new roof on the entire thing. So you might potentially be able to deduct that percentage of the entire cost. Things like a new AC system, if you put new flooring in the home office, those sort of things are things you're going to want to track. And if you qualify for the home office deduction, you're going to want to make sure we're taking those too. And it's real interesting with this one. Traditionally, in the past, I think, from what our perspective, clients were a little more hesitant to take the home office deduction. But now, in this post COVID world that we're living in, we're actually seeing sizes of home offices increase where people have multiple, sometimes husband and wife both work from home. They've both got their home office. People that do podcasts and videos or building studios in their home and being able to deduct those as home office deductions. You're seeing clients, use their garage as storage facilities and those sort of things. So, my main messages here is don't shy away from the home office. As I said in the beginning, it's probably not going to save you millions of dollars over the next few years, but it routinely equates to 6, 10, $12,000 per year in deductions that if you're entitled to it, we want to make sure you are taking advantage of those. And so that's first one. Second one of my personal favorites here, kids on payroll. A lot of people don't realize that your children can actually work for you. And before I go into this one, I want to say they have to actually work for you. They have to actually perform some sort of service, and you have to pay them in line with going market rates. So this is something that they have to actually perform a service for you in your business, and you have to pay them in line with going market rates. And so the interesting part there is there's no age limit because they're your children, depending on labor laws in which state you live in. The couple things to consider is it has to be considered normal and necessary. They need to be properly set up, and this needs to be defensible. And so, what does that mean? I like to give the example of my children. I have 2 sons who I love very much. They're 3 and 5. And so if I were to claim, my 5-year-old son was helping with tax returns and doing client facing activities and paying him a exorbitant salary every year, that's not going to make sense. It's not going to be defensible. It's not going to be normal and necessary. But, on the converse, once they do get a little bit older, especially this day and age and generation, once they're in that 8, 10, maybe 12-year-old age, if they're managing your social media for you, if they're, designing and updating your websites, if they're putting together mailers and sending those out to clients, those sort of things. Think along the lines of a job that you're going to have to hire someone else to fulfill instead of hiring somebody from an outside service or whatnot. You can hire your own children. You can have them on the payroll as long as they're providing a service for your company. You're paying them in line with going market rates. The cool part here is you can actually pay them up to $13,850 in 2023. This went up over $1,000 from what it was last year, almost 1,000. So you can pay them up to $13,850 in 2023. That money is a deduction from your business, and then it's tax free to them as your children. So this is a great way to get a deduction from your business income, then be transferring wealth to your children. And a lot of people say, well, like, what are they going to do with that money? And I try to stay away from the terms, anything and everything, but you can do whatever you want with the money. You can use it to pay for expenses. A lot of parents will see, think along the lines of things like taekwondo or soccer, or football fees and all these sort of activities that you're already sort of paying for the child, out of the family income. You can use this money that's then paid to the child to fund those expenses. We really good strategy here is you could use it to invest in a Roth IRA. So since your child now is considered to have earned income, they could invest this money into a Roth IRA every year. What we've seen clients do here is this really has a compounding effect. You think over, 6, 8, 10 years, a Roth IRA, you can put a little over $6,000 per year or $6,000 per year into this account. It has a compounding effect. So now it's growing post-tax with the current stock markets or whatever investments that the Roth IRA is holding on. It has a compounding effect. We've seen clients do this for 6, 8, 10 years and then use those funds to fully fund, you know, college savings plans or, gift to the child to buy their first investment property or start a business or those sort of things. It's when you get into proper tax planning, say in the beginning, it's really all about thinking forward. We're not just cleaning up what happened from last year and trying to get you to minimize how much you're going to write a check for. We're thinking 5 years down the road, 10 years down the road. How are we going to save as much on taxes as possible and be building generational wealth as we go too? And just think about the responsibility that this is going to teach your younger kids, and that 8-year-old, 10-year-old, 12-year-old, really developmental time. I can't think of a better way than to give them a job. I jokingly say, my children, when they're old enough, they'll never earn an allowance, but they will have a job from the minute that it makes sense. So that's number two is kids on payroll. RPs, that stands for qualified retirement plans. And I want to spend quite a few minutes on this one here because it very, very can be very, very impactful, very similar to that Roth IRA compounding over time. This is for the business owner themselves and qualified retirement plans. There's a whole bunch of them out there. Don't have time to go into all of them. So I just want to talk about three of them real quick. The first one's an individual IRA. So this is by far easiest, most simple to set up and get going. You could probably set it up with whoever you have your current business bank account with. A lot of times you can do these online without even having to go into the bank or anything like that too. So very simple, very easy to set up, very streamlined from a paperwork and ongoing maintenance perspective. In 2022, you could put up to $6,000 into an individual IRA, and that money is tax deductible for you. In 2023, it's going up to 6,500. So the cool thing here with individual IRAs, you actually have till the extended tax deadline to make those contributions to them and count them for the previous year. So this is one that we see commonly used. Like I said, one of the more sort of entry level qualified retirement plans that are available to business owners. As your business grows and becomes a little more successful, once your income is a little bit higher, you might want to look at something like a SEP IRA. So SEP stands for Simplified Employee Pension. And it's an individual retirement account that you can put in 2022, the limits were 61,000. In 2023, the limits are up to 66,000. So $66,000 that you can put into these plans. That money is a deduction from your business income for you and now growing in a tax deferred vehicle, which, by the way, with the IRAs, these individual retirement accounts, if you go through, a mainstream institution like a Merrill Lynch or one of the big bank institution types, a majority of the time they're going to have you invest those funds in mainstream securities, basically in the stock market. There's alternative investments that you can do. So with these retirement accounts, depending on the institution that you choose as your intermediary, you can invest them in things like real estate. We see that as a real common one. Cryptocurrency. There's funds with IRAs that specialize in purchasing other businesses. There's all sort of alternative investments you could begin to invest this money, and it just doesn't have to go into the stock market. And so with the SEP IRA, kind of like I was saying, this one is for once your business reaches a pretty successful amount, you're going to need, several $100,000 per year in income to truly max this out and to make the investment make sense. But we're getting to the point where, we're getting a deduction from our business income. We're putting money away from retirement. And, I would never use the term free money, but one of my favorite things about qualified retirement plans is they're different from your typical tax deduction in the sense of, to get a deduction for a marketing expense, I have to go spend the money on marketing. So I go spend 50 grand on a marketing campaign, I get a deduction for $50,000. With an IRA or with a qualified retirement plan contribution, we're getting a deduction for the full amount, but we're getting a tax savings there too. And so just to give you like a quick example with this, let's use 60,000 for an easy number. I'm putting $60,000 into this individual retirement account. I'm in a 30% tax bracket. So I'm actually saving $18,000 on taxes that, like I said, I would never use the term free money, and it's not common that the IRS is going to give you a tax deduction for saving your own money, but that's what you're doing is you're transferring the money from one place to another, saving $18,000 in taxes, and now this money is in a tax deferred account that you can invest in basically whatever you decide at that point. So that's a SEP IRA. Another really cool one is the solo 401k. Probably my personal favorite here. Kind of like, with your same thing with your children. You're not supposed to have a favorite, but when it comes to tax deductions, the solo 401k is probably one of, if not my favorite out there. So this one has the same limits as a SEP IRA, as a $61,000 was the limit in 2022. 2023, it's going up to $66,000. Really cool thing about this one is you can actually add your spouse. If your spouse works in your business with you, then you can actually both contribute this $66,000 number in 2023. And so think about that. That's over six figures. And like I was saying too, your business needs to be generating a substantial amount of income for these to make sense and truly max them out. But when you are, these are incredible plans and incredible deductions here for you too. So if you and your spouse both work in the business, you can contribute over six figures to this account. Money is deduction from your business income, and then it's now in this tax deferred vehicle for you too. And so really great. Just kind of overview of qualified retirement plans for you right there. That's number three. We go to the Augusta Rule. This is a really fun one right here. So that's the nickname for it. The IRS doesn't call it that, believe it or not. And this is actually, this came from the Augusta National Golf Course, the big fancy Masters golf tournament that they do every year. So this is the story. I've never actually verified this, but this is the old wives' tale of where this deduction came from. Was the residents of Augusta, Georgia, who had all these big fancy houses around the big fancy golf tournament that happens every year. They wanted to rent those out because people were willing to pay a pretty penny to stay in these nice houses, have a nice view of the course throughout the whole tournament. And so they actually lobbied to Congress, went and got the IRS to approve them being able to rent out their homes for up to 14 days per year and not have to pay taxes on it. And so this is Internal Revenue Code Section 280A. Like I said, the IRS doesn't call it the Augusta Rule, it's just a nickname. But Internal Revenue Code Section 280A says you can rent out your home. If you own your home, you can rent it out for up to 14 days per year and not have to pay taxes on that income. And so it's a lot of different ways that could work. I mean, I could only imagine having one of those houses that's around the Augusta National Golf Course, what that would rent out for up to 14 days. But assuming, $20,000, $30,000 we're talking that you could bring in as tax-free income. So there's a lot of different ways this is utilized and worked, but there's really two main strategies that we see. You can rent your home out. So you can use something like Airbnb or VRBO. There's events coming into town something like the Super Bowl or some big concert or whatever it is where you could actually rent your house out. You can do that up to 14 days per year. And the income derived from that activity is tax free to you as a homeowner. As a business owner, which 99% of you guys are here, your business can actually rent your home from you up to 14 days per year. And the income derived from that activity is a deduction from the business and it's tax free to you as a homeowner. And so when we talk about this here, we tend to get a lot of questions. Like I said, if we were in a live room where I could see everybody, this is where all the hands would go up real quick. So if you do have questions, type them into the chat there and we'll get to those at the end. But as a business owner, your business can rent your home from you up to 14 times per year. The income derived from that activity is a deduction from your business and it's tax free to you as a homeowner. So how does this work? And so I always encourage clients to think along the lines of events or marketing activities or meetings or something you're going to need to rent a space for, like at a hotel meeting space or a private room at a restaurant or for some sort of networking event or anything like that. Instead of hosting this event at a hotel or a restaurant or wherever else, or renting a boardroom for the afternoon to have your monthly board meetings, you can host the events in your home. So if you're going to do this, there has to be a specific business activity. You have to charge in line with going market rates, which we can show you where to look all that stuff up to make sure you're comparable. And instead of paying an outside source to host the event, you can host it in your home. So think along the lines of networking meetings with clients, monthly board meetings that we're going to need to have, sales meetings, those sort of things. Anything, but try to stay away from the term anything, but types of events that you're going to need to rent a space for typically instead of renting an alternate space. You can host that in your home. Essentially, your business can pay you instead of your business paying a different location for that. The money is deductible from your business and then it's tax free to you as the homeowner. So that's a really fun one right there. Last but certainly not least, and this one, I know it's probably not the funnest one to talk about, but it's insane to me, especially when people's businesses cross that seven-figure mark. You get into, seven figures, multiple seven figures. Good bookkeeping is incredibly important for a number of reasons. The biggest one is to make sure your numbers are accurate and you're getting all of the deductions that you're entitled to. And so we routinely on $1 million business, we'll routinely see customers who will do the books on their own or, have their sister-in-law or father-in-law, whoever it is, handle the books for them. And they're not reconciled at the end of the year, which I'm going to go through that here in just a sec. But on $1 million business, we'll routinely see $20,000 to $30,000 in bookkeeping mistakes that can cost the owners of the business thousands of dollars in taxes. And so, good bookkeeping is so essential for a lot of reasons. The number one thing is you got to have a separate bank account. You guys know this. You've all graduated past that stage obviously, but having a separate bank account is key. Commingling items in your personal account and having to go back and clean things up at the end of the year is just not something that we need to be doing. You must use a separate account, have all of the income flowing into there, have all of the expenses coming out of there. You need to use some sort of bookkeeping software. So QuickBooks Online is the preferred software that we use. It's actual accountants software. So there's a ton of other ones out there. Hurdler, FreshBooks. I mean, I could go on forever. Use some sort of bookkeeping software, and the biggest thing here is we need to categorize and reconcile. And so we see this all the time too. And I promise here we're in the trust tree. I'm not picking on anybody by any means, but we see it all the time and it blows our mind where customers will manage their own QuickBooks file themselves and they're really proud of it. They're like, I go in there and I categorize everything every month. So I'm going to give you this P&L and I know it's accurate. We're like, okay, that's great. Everything's categorized, but have you reconciled? And we always get that same question is what is reconcile? And so reconcile is a fancy word for double check. That's what you need to be doing with your QuickBooks Online account on a monthly basis. And so essentially what it does is double checks the numbers in the business bank account and the numbers in QuickBooks Online. So although QuickBooks Online has gotten a lot better, honestly, and it's getting a lot more automated, it's using some AI technology to recognize transactions and stuff, it still has little hiccups where it'll double up transactions. Sometimes it'll double up expenses. Sometimes it'll double count an invoice as getting deposited. We routinely see clients having issues booking credit card payments when they're booking the payments that they make on their credit cards. And so All of these little things as your business grows and grows and grows, you want to make sure they're more accurate. So, A, we're reporting the right amount of income and the right amount of expenses at the end of the year. But B, you want to know what's coming in and what's going out on a regular basis. So, we want to get to the point where every month you've got an accurate P&L where you can tell exactly how much money came in, exactly how much money came out. So, you can start to make better decisions on how to run your business. And so, on bookkeeping, another very important part is the chart of accounts. And like I said, I know bookkeeping isn't the most exciting thing to talk about, but it's so important and it's so impeccable, especially as your business grows, because you need to have the right information to make the right decisions. And one of the most important ways to do that is, or one of the best ways to do that is customize the chart of accounts. And so when you're doing that, you're going to be able to break down the revenues and expenses by type. And so when I say that, and like I said, we're in the trust tree here, so I'm not picking on anybody. I promise, just using these as an example. It blows my mind every year. We get clients will send us their P&L and it's, $800,000 and it's under fee for service income. So it's basically one type of income for everything that came into the business for the whole year. And we're always like, wow, that's great. You did $800,000 in sales and you just sell one thing. And they'll typically kind of chuckle like, no, we sell like 10 things. And it's like, well, how do you know how much you sold of each one? Like based on this, it's just you did 800 grand and that's great, but it's all marked under one chart of account here. And kind of like, oh, it's kind of this, you know, eye-opening moment of when we customize your chart of accounts, what we do is we start to break down the different lines of revenue. And so for you guys in the coaches business, this is like, instead of $800,000 fee for service income, it's, $250,000 in live events and masterminds, another $200,000 in online courses, 200,000 in group coaching, 150,000 in private coaching, whatever these different products, whatever your different services are, you want to customize it where you can see how much came in for each item. And then a step further is that as we start to tie the expenses to those lines of revenue, so we can do what's called true cost accounting. We can show you which lines of revenue are the most profitable for you. And this is usually, not all the time, but this is usually a pretty eye-opening exercise that we do with our clients because they'll realize they're spending the least amount of time or they're spending the most amount of time on the line of revenue that's the least profitable, which that's not the idea. That's definitely not what you want to do. So as boring as it is to talk about, good bookkeeping is really essential to what we do from a tax planning perspective, and it's really just essential from an overall running your business perspective too. And so those are the top 5 deductions for coaches and consultants, top 5 tax hacks. The message I want to get to you guys today is you need a plan moving forward, right? We talked about tax preparation. What is that? Tax preparation is for last year. So right now in 2023, we're doing tax preparation for all of our clients in 2022. There's a little bit of stuff we can do for them, right? And obviously, if we can, we will. But for the most part, we're being reactive. We're going back and we're cleaning up things that already happened, and we're really just getting you in compliance. Every year the IRS says you have to file a tax return, so we get that done for you. And that's how most people, most business owners are used to doing it. They put in an extension, say, I'll worry about it. And September or October, and by that point, we're almost a full year behind. Think about that. So we're being reactive. We're cleaning up from last year. We're just getting you in compliance. We're compared to tax planning. We're moving forward. So right now in 2023, we're doing tax planning for our 2023 clients in April of this year. That means you got 8 months to make a strategy and put it into place to legally and morally pay the least amount of taxes. You want to get to a point where you're being proactive about this stuff. When we do it that way, there's lots of things we can do. These 5 deductions I shared with you guys is just the tip of the iceberg when it comes to that stuff. And what happens is we're moving from compliance work, which is cleaning up the past, to advisory work, which is what you guys do as coaches, as consultants. You're advising your customers, you're advising your clients on how to grow their businesses or move in the right direction or hit their goals or whatever it is too. That's exactly what we do for our clients at Action Accounting. And so hopefully you guys found this beneficial. Hopefully we got a few minutes for questions if there is any. I do have a link, Natalie, to send out to everybody as a member of this event, we wanted to offer a free strategy session. It'll literally book 30 minutes on my calendar where we can go through your situation, talk about whatever it is you have going on, see what we can come up with to help you out for a good tax strategy for the end of the year. My ebook also, it'll be done any day. They've been saying that for a while now, but I think it'll really be done any day. It's in final editing or whatever. I'd love to copy of that to everybody who attended the event. So I'll get Natalie to send that out to you guys or get me the distribution list or figure out how to get that out to everybody else too. But I'm Jake Alexander with Action Accounting. Hopefully that was beneficial. If you guys have any questions, we can take it from there.
Awesome. This was a great session. We are at the time right now, but the biggest thing that my takeaway is tax planning and good bookkeeping is really a part of like bigger financial operations that can fit into so many different aspects of a business, including not just tax planning, but like business planning. I love how you said that you're sitting down and doing this exercise when you're figuring out that you're spending majority of your efforts on a line that is not really bringing you the high revenue.
It's a humbling experience, but it's a very important one. And the sooner you understand that, just the better decisions you can make and you can move forward exponentially. So, yeah.
Awesome. I will share the link with everyone. Be on the look in the email shortly after this session, and we'll see you in the next session. Jake, thanks a lot for taking the time.
Thank you so much. See you guys.